Oh man, I really must have slept. Gosh, it's morning time. Anyway, I guess I've got to enter stock market. Right, where did I put my laptop? Wait. Do not do that. But why? It's not good to invest as soon as the market opens. But why? Hey, I'm talking to you. Do not invest. Hi guys, it's your favourite YouTuber again, Diff, and you're watching Diff Finance. Whoa. If you guys are like Mr. Sleepy and think about entering the stock market as soon as it opens, then it's good I interrupted you guys just now, because I stopped you from making such a big mistake. You all know that the stock market opens at 8 a.m. in the morning and closes at when does it close? 4:30 in the PM in the evening. Yeah, we all know that. And it's open from Monday to Friday. But just because it opens doesn't mean that's the best time to invest, does it? No, it doesn't. Now the stock market is one of them few places guys, yeah, where you don't actually have to be early. Like, actually being early makes it worse for you guys. So you don't want to enter in too early. I'll explain why later on. But yeah, you want to enter in when the market's thriving, when everyone's on the market, because that's actually when you can get the best prices and when you can sell at the highest prices. Not as soon as the market opens, i.e. 8 a.m. in the morning. You don't want to enter then, guys. Now, I'm not saying as well be terribly late, because I know there's some of you guys that do like to do that. My brother included. He's so late to everything. Everyone has that one person that is late to everything. For me, it just happens to be my family, my friends, everyone I pretty much know, just late to everything. But that's another story. What I'm trying to say is you don't want to enter in when the market just begins. Why? Because of one word: spreads. Spreads are massive when the market just begins. Massive, I say. For instance, right now, Apple has a buying price of its stocks of roughly $169.65, and its selling price is $169.64. This gives a percentage difference of roughly 0.006%, which is barely anything, which is good, because it means that your investment doesn't need to work that much harder for it to make a profit upon itself. The smaller the difference between those two prices, the easier it is for your investment to make more money for you, because you're therefore making a profit. But when it's the other way around, in the morning when the stock market just opens, you'll find that these spreads are massive. Yeah, so maybe Apple might just have that same buying price, which is £169.65. $169.65. Okay, we got there eventually. But then you may find that buying price is still the same, but the actual selling price has gone down drastically. So instead of being $169.64, it is now $160. That's a 6% percentage difference. And that effectively means your investment has to work that much harder to make a profit upon itself. And that's what you don't want. As an investor, you want to be emotionless, but your investments are lazy. You want them to barely work and still make you as much money as possible. You want to be rolling in the stuff. So like, you don't want to work harder than what you need to. You definitely don't want to do that. And that's why you want to particularly avoid spreads early in the morning, because it's just such a broad spectrum of prices upon which an investor can basically get trapped in and fall with it. Did someone say something? Oh snap, it's 9 a.m. now. I was meant to invest an hour ago. Oh man. Where's my laptop? There, Mr. Sleepy. You just go back to bed, okay? You just go. You're probably thinking, why does this occur? Why does this happen? Surely I'm going to be one of the few people that's investing into the stock market when as soon as it opens. That means I can pretty much dictate the price and stuff. No, that's what it doesn't mean. As soon as the stock market opens, there are relatively very few investors on the stock market. So your spectrums become so broad and wide. Whereas when the peak time occurs, when most investors are on the stock market, things tend to narrow down again, and you tend to have a more competitive market, a market where you can find a lower buying price, and a market where you can find a better, higher selling price. You tend to have that occur more as the general trend, as people tend to invest during the peak times rather than investing during the not so peak times. Okay, you know what? I've kept telling myself I'm going to enter the stock market. Now I'm going to do it. I'm fully awake. It's 11 o'clock. It's time to invest. Okay. Where's my laptop? Quite rightfully, like Mr. Sleepy said, 11 o'clock is a good time to invest. 11 to 1. Those are sort of time windows, time frames that you want to aim for when investing, because that's when most of the people are on the market. Like I said before, this is a generic rule that I use, and now you guys know about it, so I filled you in. But yeah, hit me up in the comment box below if you guys feel like this was quite insightful for you. Also, hit me up if you've actually been that investor on the other end that's arrived in a bit too early and then later on has realised that, you know what, I bought that stock for, I don't know, £10, but I really could have gotten it for £8 if I'd waited a bit longer. But yeah, hit me up in the comment box below if you're that guy. Don't worry, I won't shame you. I will just laugh inside. But yeah, don't forget to like, subscribe and share. DS Learning Finance. Whoa. Whoa. Bye. Whoa. 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 Whoa.